Good afternoon, everyone. First of all, you can see I'm by far the oldest person that's moderated. I'm using a notebook and not an iPad, so brace yourselves. Thank you, my panel. I think everyone here knows their topics. I think a lot of what we, in the prep for today, wanted to discuss has been touched on today, in some instances answering some of the questions, and in many cases maybe segueing us into some of the topics we wanted to touch on. So the foreign perception of South Africa, I mean, some of the cold facts don't read so well. According to McLagan, the South African Commission wallet reached its lowest point ever last year in the CEMEA wallet, smaller than Saudi now. So that's obviously concerning. You see foreign ownership in our market reducing, where active managers are playing less of a role in unlocking value and bringing capital into our market, and that is of concern. Yet our market continues to evolve. It runs on world-class technology. It's got, I think, really good people. The infrastructure is solid. The exchange has been around for many, many years. So the marketplace is there. And it feels like there's a lot going on, and a lot of it could be driven by macro factors. Just last year, after the elections, we saw money coming back and the SA Inc. stocks getting bought up. But now you're seeing that fading because you don't get the sense that there's foreign money coming in. And at the same time, the world's changing. There's T+1 that's coming in. There's digital assets. There's the move to ETFs. So there's a lot happening. And I think what we want to touch on a little bit as a panel, we want to encourage you to put your hands up and ask questions as we go along to try and get it to be interactive, is to touch on all of those points. It's obviously hard to decide when an active fund manager should be buying a stock in South Africa rather than somewhere else. But there's a lot going on, and we want to touch on some of those subjects as we go along. So I'm going to go straight over to Scott and say, Scott, so when you think of South Africa, what's the first thing that comes to mind?
Hello everyone. I'm Scott Charity. I work for Berenberg, and we're very keen to teach you stuff today as well. So I hope you all learned something. So I work for Berenberg, which is the oldest investment bank in the world, 1590. That's one thing you just learned. The second thing you're going to learn is what I told Laurie about 6 months ago, that no dinosaur ever flew or swam. They didn't happen. So that's two things you've learned.
My son's heart.
And I did break her son's heart as well. But I got told by my boy who was 5. Now, but going back to your question, earlier on they said that the world, or rather some Europeans, don't look at South Africa being the gateway to Africa. Well, that's not true. I've been doing this for a long time, which is probably why people at the back can just see my blue eyes and I just blend in with the background. But when you build an electronic trading desk, as one example, when you build an electronic trading desk, the first thing you do is you look at where you want to market, where you're going to trade. Then after that, you go, what exchanges are easiest to go to? And then once you've done all the ones in Europe you want to go to, the next one, if you're going to do global, is South Africa. So it is the gateway into Africa. You always do it that way, and I've done it cut and rinse and repeat multiple times. Anyway, that's another thing. You go away and become millionaires. Going back to your question, there's a lot of benefits, and I believe, and I'm just going to go out there and say this, the Johannesburg Stock Exchange should be flying a flag and saying, we are the Johannesburg Stock Exchange, and we are the gateway into Africa. We have certain standards that we trade to. I mean, all jokes aside, no one's going to be perfect at everything, but there has to be a marker which is then going through the rest of the country, or the continent rather. And I'm happy to answer any questions about European liquidity and European markets. But there are massive benefits. And I'll hand it back to you because I know I've been talking for 3 minutes.
Thanks, Scott. Yeah, I think one of the points we'll come back to is liquidity.
Yeah.
And it's come up a lot today, but that's not even touched on the fact that if we're the gateway to Africa, African liquidity has gone nowhere and has shrunk immensely over the recent years, in the last couple of years. So we'll come back to liquidity, but I just want to go to Val. So Val, when you go and you attend the conferences and you travel and meet with investors globally, how are you selling South Africa to them, and what's the perception you get back from them?
Yeah, I always disclaim it as I'm always bullishly optimistic, so that I would stand strong. But we'll come back to the point of liquidity. And I think one of the things is we look at the macro factor of SA, and we know the doldrums of the last decade that we came out of. And it feels like we're coming from a resurgence now of our own laggard effect through our market. We spoke about SA's relevance and how that has tapered down over the last decade. But if you have a look over the past 24 months or past 18 months in particular, SA's value proposition has become quite compelling in that we're on the surge for our own re-rating. But secondly, we're actually standing quite competitive and comparable on a global arena right now in terms of activity, our market structure, the way we service the market. So one of the other panels spoke about a lot of the investment into markets has come at the expense of, it's been going into the US. Everyone has been crazy about the US, and 80% of global flows go to the US. So you're finding the same doldrums of lack of liquidity, even European markets. Less than 4% of savings are invested into the UK markets. So as the JSE, as South Africa as a marketplace, one, we think we need to put the value proposition of SA forward, what is happening at a macro level to translate into growth, and then the capital markets are a good outlet for that. But then two, what do we offer as a marketplace in terms of the skills, the technology, the listings alignment and framework of saying, come and actually secondary list in our market. We've got a deep institutional base. We spoke about what Reg 28 meant, but actually you're seeing reinvestment into our market. And the question is, how do you get the catalyst for foreign investors to pay attention to South Africa, not just as South Africa and the returns, but South Africa as a competitive marketplace? How do we deepen that liquidity? How do we get more dual listings? So I think there's two parallel streams of positioning South Africa at the moment. One is the value proposition of us as a country to re-rate and unlock some of that potential. And then two, actually as a destination, as a jurisdiction, we are globally competitive in what we can offer and how do we attract more of those flows and listings.
Thanks, Val. I think on that point, Laurie, I want to come over to you a little bit and just say, looking at how the market structures are shifting, where money's going, where regulation is starting to squeeze people, the shift from Europe into the US. One of my colleagues just been in the Middle East, and they found the hedge funds are moving from Singapore to Dubai. Those forces, how's that shaping where South African emerging markets are sitting in?
Yeah, hi everyone. Thanks, Quintus. I think that's a really good question. And Val, what you said about sort of how you're positioning South Africa in the global market. You mentioned the Middle East. I think just to explain a little bit about where I sit, I'm the head of capital markets at Euromoney. Despite the name, we're a global research and accreditation platform, and we do a lot of research and analytics and awards and surveys around comparing performance across markets. And you can very clearly see that there are some markets that have taken a particular approach, and that approach has been very successful. And if you're talking about market structure, you mentioned the Middle East. I think Saudi is a very good example where what they've done is they've really focused over the last, I would say, it's been going on longer, but the last kind of 3 to 5 years, there's been a real acceleration. They now take up 3/4 of the trading value of the GCC. They've got a market cap of I think over 3 trillion now, and they've done that by implementing really rigorous market structure reforms. They introduced a T+2 settlement cycle, which has made a real impact. They introduced Mukasa, which is a central clearing house, which has made a real difference. They've got a delivery versus payment settlement model. They've got an independent custody model. And I think that what that's done is really taken them to become the gateway to the Middle East, North Africa region in the way that I think South Africa is looking to do for South Africa. And I know, Val, you and I have spoken about this. The JSE is well on the way to implementing reforms along the same path.
Yep.
How far are we?
Too far if we look at the whole list, but I think, and we'll probably come in terms of this, in terms of regulation, and we had T+1, T+2 conversations. There's always going to be a lag effect that we have to catch up. And then you also see from what Will had discussed how convoluted MiFID 1 went to MiFID 2, MiFIR, and then undoing some of that. So I would say we probably can move much faster, that I agree, but we need to be more selective, of how we go, because we can't overhaul a very old market where some things work, but you want to keep abreast. And I think for us, it's about how do we keep relevant in terms of what do we want to keep up with versus how fast do we want to change without completely spending too much money as an ecosystem, time or effort to actually do it. And I think that's what these forums, this collective is. I'm actually quite proud that we have the closeness of this industry, very vocal, very, very open, but we actually can come together to challenge each other or say, selectively, can we get people around the room to choose what do we do next? Is it T+1? Is it a central clearinghouse? No doubt that's the global pathway, but it can't come at an opportunity cost of this market. You always talk about ESG and the hot debate about stranded assets. And to me, some of these choices are like stranded assets to this environment, this industry, that we don't want to expense it, but we want to be relevant. And I think we will be fast in being relevant, but we may not do the overhaul off the bat.
But there's a benefit to that second mover advantage, right?
Absolutely.
You can stand back and you can see what other people are doing.
Yep.
You can see what mistakes they make, and then you can make sure that you do it better.
100%. Yeah, agree.
But there are certain things as well you have to be very careful on. I'm talking this as an industry. If Europe goes, well, it's going to go T+1 in October 2027, and Switzerland, so the whole of the continent, as we're talking about continents, the whole of the continent is going to go T+1. So it's a matter of time before SA has to go T+1, because the way that brokers are set up globally, the headache will be Asia because of the time difference. Whereas, quite frankly, this should be an easy win without all of the fungibility issues that we've spoken about. It should be an easy win to plan out. I mean, it's October 2027, right?
Yeah.
Even if you did it 2028, it's still it's a goal and something that you can plan and go for as well. But there are issues. Well, I know we spoke yesterday, we spoke with Velocity and a couple of other brokers about the fungibility and the settlement and the dual listing of the trades. But it's about trying to track that back to the JSE and back to South Africa, and then go from there. Because what you don't want to do is fracture. I mean, I know I'm telling you the honest truth, and everyone knows. We don't want it to fracture. T+1 comes around, and you can settle in Europe on a dual-listed instrument. I mean, according to the brokers and the market makers, they might go one way or the other. So it's just a matter of planning. But I'm not here to tell people how to do T+1, obviously.
No, it's very interesting for me, and I just want to remind the audience, you can put up your hands if you want to ask a question. There's obviously the WhatsApp line that you can also post questions on. Aim them all at Scott.
Scott T+1, Scott market structure.
And if it's anything to do with dinosaurs, he'll answer that tonight after the session.
It's not Chatham House either, is it?
I'm still going to verify
Scott
the
calls someone
dinosaur
dinosaur.
fact, but anyway.
What we need is someone to Google whether that's true or not.
Did Scott say something about the JSE and a dinosaur? Please quote. What a nightmare. Out of context 101, that would be, wouldn't it? I'm ashamed it's not Chatham House. Anyway, let's go back.
So Scott, just if you say you set up South Africa first, out of the other regions that you set up, how do you sell it then, and what's the response?
What do you mean when you're setting it up?
You set your platform up, electronic trading, you set up the access.
The truth is as well, but because, I mean, historically, the way that the Johannesburg Stock Exchange has been, having the Millennium System and things like that, it's always had like more of a European twinge about it rather than a twinge about it, which has always meant like, historically there's a dual listed instrument. So it's not even a selling point internally or externally. It almost goes hand in hand. As you're doing it, you'll go that way. To be quite frank, the harder bits are when you go to the Saudi area because of all the background checks and who you're trading with and what you're trading against. So they're all a little bit harder, and the emerging markets are even worse, should we say.
I was hoping we could just explore the regulatory framework, and there's a lot changing, and what I found in South Africa a little bit now is that JSE, who's our regulator, comes out with regulation that needs to go up to the one regulator, one level up, and that delays stuff, and there's a lot of engagement at 2 levels now. How critical is it to reduce that friction?
Oh, I wouldn't have said reduce. It's what you have to have is better communication, and not just from a broker and an exchange. It needs to be the brokers, the exchanges, all having a conversation with the regulators at the same time. So the consultation papers on, we're thinking about doing this, you can have a closed door session and have a chit chat about how you could possibly do it. And it should never be, we can't do this. And it's got to be a positive spin. And it always has to be a positive spin, otherwise things won't get done as they should be. There will always be different interpretations to a regulation. I mean, we'll probably come on to dark books in a minute, and according to how they work. But that's always going to be the way. I mean, as we just touched on the dark books as well, I mean, the Europeans didn't want dark books, right? They didn't want it. And Brexit comes along. Sorry, I used the Brexit word. Brexit comes along, and they said, well, you know what, we love dark books. Well, I mean, we have all day long. All of a sudden, we've got dark books spinning up in Europe over the last 12 months. Now, some of the exchanges, and they're not in the room, so they've implemented them poorly. and poorly because of the way they set it up from a liquidity point of view. But the worst part was how they set it up from a transactional reporting point of view.
Yeah.
And we're not going to get into that. But basically, the MIC code was never set up properly. And as a market structure person, I always tell this internally, the only thing you get fined on is transaction reporting. You do not get fined for trade reporting incorrectly. It's always transaction reporting. Yeah. So when people set up a new book, should the JSE ever set up a book, then as long as it's set up correctly and the information can be consumed, it's just ticking the box.
Yep. And maybe just to add the point to friction, one of the things that we see is even developed worlds, they had good intent with regulation, but it stumbled all on top of each other where it had unintended consequences to the point, and Laurie, you sent me the interview you did with the SEC regulatory head, where the SEC just took a pause last year because they couldn't clean up what regulations were trying to get the intended consequences of protecting investors where they were actually having unintended consequences. I think the summarizing point is you want to be in a safe space, even without clearly defined regulation, but where there's frameworks where you can adopt new models, new products, new market structure elements. But the conversation and the dialogue is important. If I look over the past 18 months, and we always have our head of policy give us a summary of the regulations. Some are 20 years old, and some are new. But if we don't speak up as a collective, even if we don't have the same direction, but we have valid concerns, it's really important. And that's one of the roles as the JSE, and we actually see it quite fortunate that we are a self-regulatory organization to FSCA, because we actually have a direct line where, as an industry, we can bring up various topics and say, hey, this needs a pause, or it may not work for South Africa, or it's been pieced together, or actually this product has high demand, don't take it from us, take it from the participants, and can we get it done faster? Notwithstanding, we haven't done the digital assets faster, but that said, I think it's also on the premise of trying to protect an end investor, but having the luxury of an ecosystem where we can chat about it, but more collaboration, more open forums with diverse voices are important, because you learn something. There you really learn something.
Yeah, that's right, yeah.
With an open dialogue.
And even at these sort of events as well, you'll learn something. I mean, not that you haven't learned a lot already, but that you will learn something. I mean, to your point about the digital, I mean, really only Switzerland's got involved with that digital space, and they try to be more innovative. But the truth is, it's not regulated, and it's basically an FX.
And it costs $600 million.
Yeah. So,
we don't have.
Yeah. I mean, yeah. And then, I mean, to be honest with you, if I quickly talk about Europe, the amount of times Laurie, we've talked about consolidated tape or retail trading. I mean, the consolidated tape retail, we're just touching this quickly. My dad does not care about the consolidated tape. And I can answer questions about the consolidated tape, and other people in the room that I can see laughing, Rob, I can talk about it, and James is in the room as well, we can all talk about it. But the truth is, my dad won't buy a Vodafone because he's got it free, and his Google financing comes in. But they're all positive things which are innovative and good for the market. And they are good, they're good ways and they're good things that are happening, it's how you use the English words to describe it. I mean, what does retail actually mean? So when I have internal meetings or external meetings, what do you mean by retail? Is it my dad who's a builder buying a share? Or is it you're talking about someone who works for an asset management doing this because they've got actual punters coming in or a pension, Anyway. Consolidated tape. Laurie?
No, I don't want to talk about consolidated tape at all, thanks.
You're not going to learn anything from Laurie about the consolidated tape.
But if you bring it back to what Val was saying about your position as a self-regulated entity as JSE, you've got numerous models out there that you can follow, and they're very different examples. You've got Europe, which I think we'd stick our hands up. It's over-regulated. There's certainly a perspective that there has been a heavy-handed approach, and that's had its own consequences in terms of liquidity fragmentation, in terms of venue diversification, which I'm sure that we'll get onto later. Yeah. Whereas if you mentioned my meeting with the SEC a couple of weeks ago, if you look at the US approach, they've taken a very different stance, and that stance is going to be doubled down upon. You've had Gensler as the chair of the SEC for the last 4 years, who's driven it through enforcement, who's driven it through market structure reforms. That's all going to change. change. You know, I spoke to Hester Peirce, who's the longest serving commissioner of the SEC a couple of weeks ago. They are going to focus on capital formation. They want to make it easier for companies to list. They want to make it easier for smaller, newer companies to access capital raising facilities. They want to encourage the regulation and participation in crypto. You know, they're taking that approach. And I think, as we said before, the great position of South Africa is that you can look at those two and you can cherry pick what you want to follow.
Yep. Music to my ears. I know many of you guys have asked about detail of Operation Phumelela. 3 of what you've just mentioned are work streams within that. But basically, it is a collective engagement for us to try and push forward specific capital markets reform so that it makes South Africa an investment a financial center for capital formation, for more products, for generation of capital into small and mid caps, where you can grow not only the economy but also your marketplace. I'll spend 2 minutes after this panel, because many of you guys asked, just flashing up that presentation, and then we can always come back to it later. But it's spot on in terms of saying, how do you get more generation of capital formation and product, in our case, in an ecosystem like the listed markets or the South African capital markets, even it's public and private, and it actually supports at a country level an economic zone for the region.
Yeah, thanks, Val. I think that would be good. I want to pick up on the liquidity conversation again a little bit, and I don't know who wants to take this, but you know, I think retail liquidity in South Africa has not grown. It's activity. It's gone nowhere, and it's a critical component of the market. And I think in the US, it's driven a lot of the liquidity growth. I mean, obviously, there's huge capital formation, but and if I look from the outside in our market, and somebody mentioned, I think it's Ved that said we have like a constrained liquidity pool that we work with, and it's sort of the same stuff goes around. How do we grow that? Is that?
But with the retail thing, it's like a giant snowball that you want to throw down the mountain, but you're going to create an avalanche, right? Because a lot of that then comes down to teaching, you know, the under 25s. What this means, if you buy this, you'll earn 8% a year on this. Now, you know, they all want to go and buy Bitcoin because they want to be millionaires and, you know, buy an island on Instagram. But so as an example, NASDAQ are really good in Sweden. They go to a lot of the universities and do a lot of teachings on how to invest, what investments means, how to have a portfolio. And it's a fantastic thing. But in Europe, so let's talk about Europe, because obviously that's my bread and butter, really.
Shame.
It's only Sweden and Italy where you find that, because the Italians have always done it. I mean, they've always done it. And they do a lot of bonds, but it's only those 2 countries. Now, there is a big hole globally to teach people in universities. Johannesburg Stock Exchange should be going along, and saying, this is what is happening and this is what you need to do and this is what it means. But that doesn't happen, you know. And I mean, I didn't go to university, so I'm sure it does happen somewhere, but I think it's just Stockholm. But I think education, because once you've got the education, it goes into the retail. And everyone thinks the golden nugget is a telephone that you can buy this, buy that, buy this. But that's not really the answer. That's a very quick win.
I think I'd agree it's about education, but it's also about the efficiency of the markets themselves. If you look at the US market, it's the most efficient capital market in the world. It's got robust investor protections. It's absolutely won at getting that retail liquidity piece into the institutional sector. And that's why it has such a huge pool. And that's efficiency, and that's transparency, and that's investor protections. And I think that those are the kind of building blocks that you need to put in place before you're ever going to have that retail participation. And I think the UK and Europe have struggled to do that. And I think there are, elements in motion now to try and achieve that. Like in the UK, we're seeing this, investor access to regulated access to bonds, where it's enabling retail investors to access smaller fractions of primary bond listings. They're baby steps, but that's the kind of direction and pathway that we need to be taking.
Yeah. Sorry, so just setting it out there, there's absolutely a growth profile for retail trading globally. To the point, the South African market structure is very similar to Europe and UK, where we're institutional in nature. Then you overlay that with what South Africa looks like in terms of more than half our population below a minimum wage, etc. So we don't have a high savings profile from the retail investors other than through intermediaries. So if you had to look at a short-term play to get this avalanche effect, it's through access and through lower costs. And that comes from all of the intermediaries, including the JSE, supplemented with ongoing education. Because, I mean, it's not just to make money. There's huge risks involved in investing, and that has to be moderated and explained. But it comes down to access. How easy can we make it? So one of the things we've been looking at as an exchange is how can we work closer with our broker, not to boil the ocean, but to say, with our ecosystem, what are you doing? Can there be an enabler to supplement it? Because if you look at different desks, some clients or some of the intermediaries have had good uptick in retail trade, and some have actually seen their lowest ever. So it's actually gone twofold. That said, you look at the digital assets or the crypto in particular, it's been a retail market across the continent. So people are hungry for making money and investing and growing their wealth, having some safe haven optionality to their lifestyles. But it's about how do we create better access and knowledge to expand that retail base.
Well, I think if you look at India, what they got right, and I
Yeah.
mean, they have a large poor population,
Yeah.
but then a large and when I visited there a couple of years ago, I was blown away by the retail participation. And where did that come from? By creating a lit derivatives market. And I've always
That's
felt that
amazing.
one of the things in our market that holds us back is the fact that our derivatives market's not lit.
Yeah, agreed.
Yeah, that's, I think, and the shorter dated options, same day options in the US
Yeah.
now, it's, and it feels to me like we stay, we've created the infrastructure to pull in all the HFT funds, firms and the quant
Yeah.
trading firms, and they're all here and they market make and they trade the dual listeds and the stat arb opportunities, and they do all of that. So we stay in there, but it feels to me there's other change that needs to happen
Yeah.
so that we broaden the alternative liquidity to bring into the equities market. And that feels to me like something we need to really focus on.
Yeah, I agree with you. You're spot on. US and India in particular, their activity has been driven by the derivatives market for retail. Notwithstanding, they had some concerns now from risk management because people weren't understanding the structures itself. But that is the liquidity. We've never had that because it's formed bottom up as an institutional market. And the derivatives market is actually bilateral in South Africa. Yes, there's an exchange, but most of it is bilateral and reported to the exchange, other than probably your mainline futures contract. But that is definitely probably a challenge or an enabler that if we unlock it, it would be good. Yeah, agreed.
So Laurie and Scott, with the push into ETFs, and I monitor the flows into that quite closely, and you see in the US, you see the dollar weaken, you see money go into the emerging market ETFs. Obviously that's impacted how active funds behave and the money that flows into them and where people go with their money. How as a marketplace is there something we can do? I mean, it's like I was just thinking of this, to better position ourselves, to sort of we capture that and we react to that fast. I mean, we've got a good closing auction that obviously where a lot of that flows goes into, but that means the rest of the day is almost becoming a waste in terms of capturing either that inflow or outflow.
If I'm going to be completely honest, with the ETF market, what you have to think about is how it's trading and how it's market makes as well. Because if you think about it, but say we were going to set up a broker or market maker to trade ETFs, how much data do I need to be able to pull in to be able to trade an ETF, to cut it out, unwrap it, trade it at different places? The market data alone is really expensive, okay? And that's globally, right? In Europe, it's Deutsche Börse is up like 13% in 3 years. They just don't stop going up. But to your question, you'd have to make the market data cheaper because you'd have to consume so much of that data to be able to trade and unwind.
But you recently introduced on the JSE some new ETF products, didn't you? How have they performed?
So we've even evolved to have now actively managed ETFs, so even further than just vanilla ETFs. The standard ETFs have been great. Not a lot of high value trade, but we've had a good number of issuances. Someone mentioned earlier the innovation with the commods ETFs, but they were concentrated in access products like your top 40 and your golds and your PGM plays for the ETFs. But then we saw evolution of the ETFs, bond ETFs, and now we've brought in actively managed certificates and actively managed ETFs that have proved highest demand, notwithstanding some of the challenges that we're now facing once these products become quite successful, there's always a question, are we opening up our market too much, etc. But we've seen huge demand in the products, and more so now on these actively managed ETFs. There's the blend and the acceptance that the investor profile is changing. So in fact, the AMCs and AM ETFs are more institutional issuance, which I have found fascinating. They're not sell side, they're actually end funds that are looking to bring in some type of hybrid active passive management, local offshore equities, bonds portfolios. So the innovation is hot, fast, and heavy, and we're seeing pretty good demand on that space.
It'll be interesting to see where that goes over the next year or two as well, where if that liquidity gets liquidity, and it becomes well, they've mentioned it multiple times, but it becomes self-fulfilling, which you could do. But ultimately, we're going back to pushing more liquidity on, right? It's liquidity, and liquidity begets liquidity, as they said, about 3 hours ago. I mean, I think I've quoted that twice now.
Look, one of the problems that we have in South Africa is, which the buy-side panel had picked up earlier, is the concentration in our market. So we have just under 300 counters listed, but the breadth of which only 60 or 70 are traded. One of the big questions we have to ask is, how do we stimulate liquidity further down the value chain? You could argue that you have more diverse investor, high touch, low touch, in-store retail, but there's other stimuli that we need to get a broader breadth of stocks traded, then deeper liquidity. We've also been chasing a lot of dual listeds. We've now aligned all of our listing regs to almost 18 jurisdictions to have fast-track listings. We converted 2 UK REITs last year and have got a lot of interest. And so we also have been chasing in the absence of fresh capital formation through IPOs. We haven't been seeing them come out of South Africa. We know in the small and mid caps we constrained because we're in institutional markets and the mandates and liquidity don't support it. How do we bring better secondary listings to JSE? Because we are actually a global exchange if you look at the listed counters. 80% of the top 40 represent some form of local or global diversification.
Yeah.
And so we're trying to get better liquidity by just attracting more listings. And saying South Africa is a competitive, comparable jurisdiction to trade through. And we've got this bedrock of deep institutional money and well covered from our deep and well-established sell side. It's a relevant jurisdiction to trade, and that's what we're trying to deepen our liquidity with, is more offshore counters listed in
But one
SA.
thing to note, obviously, is that IPOs globally are down. I mean, they've gone to Asia and US. Let's not mess around. I mean, they are completely down. And there's multiple reasons for that. There was this disease called COVID and stuff like that happened, and a global pandemic and everything. So, but the regulations are changing in UK and EU to try and come in line to make it easier to list companies.
But again, it's that lesson, isn't it? I mean, if you look at, it's well documented, but, the UK has really struggled with an exodus of liquidity. I think in 2024, the London Stock Exchange saw 90, including delistings as well as movements, but I think 90 delistings or exits and 18 IPOs. That's I think the worst year since the financial crisis. It's a huge imbalance.
No, 100% right. And just on the dual listed, Dublin, London, they've gone down as well. So if you look at it's a global thing. So really, it's globally, what do we do and how do we do stuff? And then it comes to working in tandem again.
And maybe it's about looking at the opportunities of where you have unique strengths, or maybe where South Africa could step in, where there might be gaps in the global market. And I know it's now ESG and sustainability is a slightly weighted word now, but you've got the US who are massively pulling back on sustainability. I mean, the SEC has put their flag in the sand and said we're not interested anymore. We're not going to be engaging. You've got all of the big players now are pulling out of these associations and these commitments. South Africa has made quite a big effort to promote your sustainability issuance. So is that an area maybe of opportunity?
Yeah, look, globally the narrative has changed as you've just described. But I think what we focused on is, one is you give investors choice. I mean, ESG is an element, but there's risk-adjusted returns that you have as a trade-off. So if you have better disclosures, investors have more information to make their decisions. So, there was a time, like 10 years ago, we were talking about South Africa, a very commodities-heavy market. Are all our miners going to get crowded out of the global arena because they don't fit ESG metrics? Guess what? We had a crisis. Even coal unbundling, coal was one of the best performing stocks in our market. What we focus more on is having disclosures so investors can make more informed choices, but notwithstanding that there's E, S, and G. There's a high element of S in ESG, which is social, and on a continent like Africa, even in South Africa, that element still has to be addressed. But we've got massive product. I mean, on the debt segment, we've launched sustainability bonds, which have expanded to green bonds, social linked bonds, sustainability linked bonds, and we have over 70 issuances in that segment. So there is still demand, but I think investors just have choice and visibility. It mustn't come at an expense of what they're trying to achieve in their portfolios or mandates.
Yeah. Yeah, you'll probably see as well, without having a crystal ball, that the way carbon trading is changing, and the way that companies are offsetting. The guy is in charge of the US, who's from this country, has got electrics, and he sells his carbon, offsets it with other people, doesn't he? And so it's a natural thing as well that's going to happen globally as well. There'll be, the boats going around the world, they have to have a carbon.
Yeah.
But we're not going to talk about carbon and petrol and stuff like that. That's boring.
We're not going to talk about Elon or carbon.
No, yeah, please not. I do want to say though that Will Ridge gave us the, Will Lynch works for Absa, sorry Willie, but he gives us lots of answers. So Reggie gave us the answer in terms of deepening the liquidities. The buy side must just pay us for the research, and we'll start covering the stocks, and thanks Will. And
go back to
I saw
Namibia
Doug
where
at the
it's-
back and a few
bit of
people, so I
unbundling.
hope they're taking that away. But obviously that is important, to the point that your research has shrunk, so there's less IP available. One or two of the sort of corporate events that we had that wasn't so great, maybe hurt a little bit of that.
But on that unbundling and the research, let's not forget that the regulators come out and said they changed everything, and the UK and Europe, and it killed, so that's probably the wrong word, it killed some of the markets. Some of the blue chip markets, like Switzerland and everything, people didn't, there was nothing coming out, and because of that, there was no one talking about it, da-da-da-da-da. So again, that becomes self-fulfilling as well.
Yeah.
So they're just trying to resuscitate by allowing this research to start up again. I hope it works as well.
Yeah.
We got 5 minutes.
We touched on everything,
we
right?
Got,
And
we
we've
got,
got
we
6
got
minutes
5
left.
minutes left. And before we go to questions, I just wanted to say, Laurie, if by any instance you ever had to write an article on the JSE,
She just
what
Just
would be the
did.
message that you take out in Euromoney to your global subscriber base?
That's the best plug I've ever had. Thanks for that tee up. We've just done an interview with Val, which is going to be coming out today. And I think that what really stands out about our conversation, about the JSE, and about South Africa is the commitment to progress. There are. As I said initially, we do lots of comparisons around lots of exchanges and lots of market participants around the world. And what really stood out in my conversation with you was how thoroughly you've thought about the independent elements that make up an efficient, quality, liquid, functioning market. And you've done everything from the colo to, making it more cost-effective and cost-efficient for people to access, market participants to access that, right the way through to looking at data access, right the way through to looking at, the liquidity aspects, whether or not those have translated yet. So, I think it's the commitment to progress, with an element of caution.
Thank you. Okay, to the floor. If there are any questions.
Oh, we ticked off so many boxes, no one's got a question.
I would have a question about private markets, which I think is the one thing that we haven't talked about, only because there was I got in my inbox literally 5 minutes before you were due to come on stage, I got an email saying that there's a new index in Europe that measures the performance of private markets over public markets, and private markets have outperformed public markets over the past year by something like 4 times. I think the performance was 9% compared to 2%.
Yep, absolutely.
How is that an opportunity?
It's very relevant. The problem remains exiting.
Yeah.
And that's and private equity and private markets in SA had gone through a boom patch, and now they're struggling to actually exit those positions and to liquidate
absolutely.
them into, because there's the demand has just not been there. Investors in SA got burned a little bit, so there's with many of them this thing that we won't touch it if it's been owned by private. So there's still a lot of perception and image work, and then you need the capital flow, I think, to come in. And one of the things we found with the Boxer IPO last year is that, it's big for South Africa, but many of the global funds said it's just below my hurdle. So you don't pull the global funds in to the extent that you think you would for a high-quality company that's huge growth rates, and that was not a private equity. That came out of a big listed company that had but it's that minimum market cap hurdle, liquidity hurdle that you don't meet. And a lot of the private assets in SA is still stuck in that sort of space. And that is a real problem. I don't know, Val.
Yeah, that, and I think also the asset allocation towards private markets. You know, we've got this traditional institutional market and investing in smaller growth companies that don't give you a return, or they're not index included and you don't know how to track it, and they are longer term structures. So I think on a principle basis, you can't ignore private markets. There's been a global shift of assets between public and private markets, and they are there to stay. The returns in private markets, obviously with cyclicality, have been great. I speak to some of the infrastructure funds in Europe, and they get 9% return in euros, steady. I mean, that's quite impressive, and it's all on yield. So we actually launched JSE Private Placements, and it wasn't an incubator for listing. It was an incubator for capital raised to a growth segment of South Africa. We've had 50 deals on there with a capital ask of 10 billion, and believe it or not, we've had almost 40 billion in investor assets on there. It's just the matching takes a lot harder because it's from your alternative investments mandate. And then, like you say, you think of liquidity. How are you going to exit it? What type of valuation are you going to be putting when some of these are brownfield projects and not getting a return yet, you know, that is sustainable? So I think there's still a longer way to bridge that gap of the risk appetite, but it's very hard to ignore private markets.
Okay, well, I see no questions, so I just want to thank you for your attention. There's
got a
one here in
question.
front.
I've got one.
It's for you, Scott. Be ready.
This
Like
man's the fittest man
dinosaurs.
in the room. No, he doesn't stop running around. Thank you. This is for him, right?
No, it's actually for you.
Oh, no.
No, I just quickly want to get the sentiments from the UK regarding what LSEG did with the announcement of PISAs. Because now we're talking about private placements, what the JSE has done, and also speaking about private markets. I just want to get your sentiments of how the perception of PISAs would work out there.
When you say perception, you mean perception from a market or from what they're planning to do?
From a market.
Because, I mean, ultimately, they've got to go that way, right? Because the way the regulations are coming out as well, it's like fundraising as well. So, I mean, if you're fundraising to start up a company and then where's the line? So, yeah, I think it's a very positive step from the London Stock Exchange to do that, is my actual answer. That's a good question. Got another one?
I would say,
come on.
I do think that Pisces was met with some doubts when it
Yes,
was
there
first
was doubt in the
launched.
industry and doubt on the street as well, and people talking about it. But personally, I mean, you've got to do something, right? So but it's again, it's what that line is and what you're going to do and how you're going to do it, you know.
Good.
Well, I'm getting a big message here that we need
Time's
to.
up.
So thank you very much. Val,
Pleasure.
Laurie, Scott, thank you. Thank you for your attention.